They told everyone it couldn't be done. They said $75 was the absolute limit. They claimed the banks would protect that level with everything they had. But today, on Boxing Day, the market delivered a decision that will be remembered for years. The barrier is gone. Look at your screen. Silver is trading at $75.60. This was not a brief touch. This was a clean break. Silver didn't just test resistance, it blasted straight through it and closed the week at the highest price possible. For the last 3 years, $75 was the hard stop. Every rally died there. Every attempt higher was crushed. That level was where commercial banks stacked massive short positions to kill momentum and scare investors. Today, their system failed. The selling pressure was completely overwhelmed by non-stop buying that simply would not slow down. In this urgent market update, we are going to explain exactly what just happened. We will break down why crossing $75 triggers a mathematical event called a gamma squeeze. We will examine the weekend disaster now facing short sellers who are trapped deep underwater, and we will prepare you for what likely comes next. The breakout is real. The old ceiling has now turned into the floor, and the race higher has begun. To understand how powerful this move really is, you need to look at the calendar. Today is Friday, December 26th. Most of the world is on holiday. Trading desks in London and New York are running with minimal staff. Liquidity is thin. Normally, banks use this low-volume environment to push prices down. They rely on Ghost Week to paint charts red and crush confidence before the new year. But today, the exact opposite happened. Instead of a smash lower, we saw a melt-up. Why? Because physical demand did not take a holiday. Industrial buyers in Asia, sovereign wealth funds, and smart retail investors saw thin liquidity not as danger, but as opportunity. They recognized that with senior risk managers away from their desks, the door was wide open, and they pushed straight through it. The move to 75.60 created a massive weekly candle. We closed the week at the very top of the range. That is one of the strongest bullish signals in technical analysis. It tells us buyers were confident enough to hold positions through weekend risk. They weren't afraid of bad news. They were afraid of missing out. Now let's talk about why $75 mattered so much. The answer lies in the options market. There were millions of ounces tied to call options sitting exactly at the $75 strike. The banks and market makers who sold those options were betting silver would stay below that level. As long as silver traded at $74, they were safe. But the moment price crossed $75, their position turned dangerous. When an option moves into the money, the seller must hedge. That means their algorithm is forced to buy silver futures. This process is called delta hedging. And here's where the feedback loop begins. Silver hits $75.10. The algorithm panics and buys futures. That buying pushes the price to $75.30, which forces the algorithm to buy even more. This chain reaction is known as a gamma squeeze. It is buying driven by mathematics, not emotion. That's why silver jumped from $75 to $75.60 so quickly this afternoon. The machines were chasing themselves. They were forced to buy at the exact moment they wanted to sell. And because it's Boxing Day, there were very few sellers available, so price had to jump higher just to find liquidity. The banks are now unintentionally fueling the rally they tried to stop. Think back to last week. Remember the fear going into Christmas? The banks were already short. They were already nervous. History just repeated, but this time with much bigger consequences. Imagine being short silver at $72. Now it's $75.60. That's a $3.60 loss per ounce on a leveraged position, with the market closed for 48 hours. All weekend, those traders are stuck wondering, what happens when Asia opens Sunday night? What if Shanghai gaps to $80? What if a geopolitical headline sends oil and silver straight up? This is psychological pressure at its worst. When markets reopen Sunday night, those shorts will have one goal: survival. They will rush to exit at the first available price. That creates a natural price floor. Every dip gets bought, not by investors, but by trapped sellers trying to escape. That's why bull markets are so resilient. Short covering becomes the safety net. Now zoom out to the global picture. We previously talked about the Shanghai magnet. Shanghai has been trading near $80, while New York was stuck near 72. Today's move to 75.60 is New York playing catch-up. That gap was too large to last. Metal was flowing east too fast, so the COMEX had to raise its bid to slow the outflow. We are closer to parity with China now, but we are not there yet. If Shanghai is near $80 and New York is 75.60, there is still a $4.40 gap. That gap acts like a vacuum. It keeps pulling U.S. prices higher until the two markets align. So don't look at 75.60 and think silver is expensive. Relative to Asia, it is still cheap. As long as the U.S. is the lowest priced market, buying will continue.
Now let's address the fear. Some of you are looking at this chart and feeling dizzy. A straight-up green move makes people nervous. It's gone up too fast. It has to crash. That reaction is normal, but in a supercycle, it's wrong. Markets breaking out of multi-year bases often move faster and farther than expected. They enter strong trends. In trends, overbought indicators stop working. RSI stays high. Price stays above moving averages. Shorting a breakout because it looks high is like standing in front of a speeding freight train. Yes, it's moving fast. That's exactly why you don't stand in its path. At $60, retail investors were doubtful. At $75, they're curious. At $80, they become greedy. We are moving from fear into FOMO, and FOMO is where the biggest gains happen. That said, discipline still matters. When major resistance breaks, markets often retest it. The ceiling becomes the floor. So next week, don't be shocked if silver pulls back towards $75 or even $74.80. That would be healthy. It's the market checking if the breakout is real. If price pulls back and then bounces from $75, that could be the buy signal of the decade. So if you see red candles early next week, don't panic. Watch the level. As long as silver holds above the breakout zone, the trend remains intact. The banks will try to shake weak hands. They want your shares so they can cover their shorts. Don't give them what they want. Now let's talk about next week specifically. This isn't just any week, it's the final week of the year. It's the week of window dressing, tax selling, and positioning for the January effect. If silver closes the year near $75, it sends a powerful message to pension funds and institutions. It tells them silver was one of the top-performing assets of the year, and that forces buying in January. The calendar is on our side. A wave of institutional money is lining up. Let's talk about those institutions. It's report card season. Every hedge fund, mutual fund, and pension fund must show clients what they owned all year. Imagine being a fund manager who ignored silver. You called it useless. You chased tech and bonds. Now silver is the standout performer, breaking $75. If your year-end letter shows zero silver exposure, you look incompetent. Clients will ask, why did we miss this? So what do managers do? They panic buy winners at the last minute. They buy silver at $75 just so it appears on their balance sheet on December 31st. This buying isn't about value, it's about saving face, but it still pushes prices higher. Funds don't buy one contract, they buy thousands. They don't care about price, they just need exposure. Watch for sudden large buy orders next week. That's Wall Street scrambling. Now shift to the physical market. While paper silver celebrates $75.60, physical supply is choking. Dealers are reporting dangerously low inventory. Boxing Day sales didn't happen.
Instead, premiums went up. Why? Because dealers can't replace what they sell. Wholesalers are closed. Refiners are backed up. If a dealer sells today and silver gaps to $80 on Sunday, they lose money on every ounce sold Friday. So they widen spreads. Spot says $75.60, but physical silver is likely priced above $90. We are approaching the $100 physical milestone. That matters. It tells us spot price is lagging reality. The spot market says 75 degrees, but the room feels like 90 degrees. Eventually, spot must catch up, and that means a violent move higher. Look at the miners. At $75 silver, miners are printing cash. If it costs $20 to $25 to mine an ounce, they're making $50 per ounce in profit. That's tech-level margins. But mining stocks haven't tripled. They're lagging. That's the opportunity. When Q4 earnings hit in January, record profits, dividends, buybacks, the market will wake up. If silver holds $75, mining stocks may need to double just to reach fair value. Physical silver preserves wealth. Quality miners multiply it. Now the geopolitical layer. BRICS nations, China, Russia, India, hold massive physical silver. As prices rise, their balance sheets strengthen. As the dollar weakens, the U.S. position weakens. Power is shifting. There are rumors, and they are rumors, that China may announce a resource-backed trade system in 2026. If silver becomes monetary again, $75 is meaningless. Historically, silver paid wages. In today's dollars, that purchasing power is hundreds per ounce. Silver is still priced like an industrial metal, not money. When that changes, charts go vertical. Now back to short sellers. Banks are still net short millions of ounces. They are bleeding billions in mark-to-market losses. They can double down or surrender. If they choose to cover, that's gasoline on the fire. Industrial demand plus retail demand plus pension demand plus bank buying, all during Ghost Week. That's why prices gap. The pressure is too high. The pipe is bursting. A word on counterparty risk. Paper silver depends on trust. In stressed markets, trust breaks. If COMEX runs out of metal, cash settlement becomes real. You get $75 while real silver trades at $100. That's the paper trap. If you don't hold it, you don't own it. Ownership matters now more than ever. Silver is rising against all currencies, not just the dollar. This is a global fiat problem. Gold led. It hit $4,500. Silver follows, but faster. Gold walks, silver runs. Right now, silver is flying. This weekend, step back. Look at the monthly chart. Look at supply deficits. Look at Shanghai pricing. Noise doesn't matter. Trend does. If silver drops to $72, it's a gift. Lower prices empty vaults faster. Higher prices fuel FOMO. Banks lose either way. This is checkmate. As we close out 2025, expect psychological warfare. They will say it's over. They will say it's a bubble. Ignore the noise. Look at premiums. Look at empty vaults. That's reality. Hold the line. The wealth transfer is underway, and you're positioned correctly. We will map January targets, review $80, and give a final readiness checklist. Stay tuned. The best is ahead.